It is 6:14 on a Thursday morning in a quiet neighborhood outside of Charlotte, North Carolina, and Robert is sitting at his kitchen counter with a single printed page glowing under the pendant light. The page is a consolidated retirement statement his advisor mailed 2 weeks ago, and the number at the bottom reads $738,400. He has read that number 11 times since he woke up, and each time it feels like a different amount of money. Outside, a cardinal is tapping against the window glass, and the coffee maker is clicking through its final cycle, filling the room with a low hiss of steam. Robert cannot figure out whether $738,400 means he is comfortable or whether he is one bad decade away from running out. His index finger traces the line between his 401k balance and his estimated Social Security benefit, hovering over the gap as though measuring it by touch. His shoulders are tight because every calculator he has tried online gives him a different answer, and he does not know which one to trust. The real question is not how much he has saved, but how long that money needs to last, and how much of it the government will take along the way. He sets the page down and stares at the steam rising from his cup, and the question just sits there. Robert is not unusual. Millions of Americans arrive at this exact moment with a nest egg that looks reasonable on the surface, but no clear understanding of how to turn that lump sum into decades of stable income. There is a structural problem hiding inside every retirement balance, and most people do not learn its name until the damage has already begun. This is the problem of withdrawal architecture. It determines whether your money lasts 22 years or 34 years. And whether your tax bill quietly doubles along the way. That is what this video is actually about. You're going to learn how the same dollar amount can produce wildly different retirement outcomes depending on which accounts you pull from and in what order. You will understand why a household with $400,000 can sometimes live more comfortably than a household with $900,000 that makes poor sequencing decisions. You will see the exact tax triggers that silently erode a retirement portfolio year after year, and you will learn a specific set of moves you can make during a short window of time that most retirees completely waste. You do not need a finance degree to follow this. You just need to stay focused and be willing to look at your own numbers honestly. Retirement is not the mirror image of your working years, even though most people treat it that way. When you were earning a salary, money flowed in one direction. Your employer withheld your taxes, and you barely had to think about bracket management. Once you stop working, you become your own payroll department, deciding how much to withdraw, from which account, and in which tax year. If you have been building your retirement accounts for 30 years, you are about to retire, or you recently did, this shift applies to you directly, and it changes everything about how your money behaves. Most retirees have 3 types of accounts, and the interaction between them is where the real planning happens. Think of your retirement accounts as ingredients in a recipe. Each one has a different flavor profile, a different reaction to heat, and a different role in the final dish. If you dump them all in at once without measuring or sequencing, the result is a mess, even if each ingredient on its own is perfectly good. The recipe metaphor is the one that will guide us through this entire conversation, because retirement income planning is really about proportion, timing, and temperature. The first ingredient is your traditional pre-tax accounts, which include your traditional IRA and your traditional 401k. These were funded with dollars you never paid income tax on, which means the IRS has been waiting patiently for its share the entire time. Every dollar you withdraw from these accounts gets added to your taxable income for that year, taxed as ordinary income at whatever bracket you land in. This is the ingredient that carries the most heat, and if you pour too much of it into a single year, it changes the temperature of your entire financial situation. Most people have the largest portion of their savings sitting in this exact type of account. The second ingredient is your Roth accounts, both Roth IRA and Roth 401k if you have one. These were funded with money you already paid tax on, so withdrawals in retirement come out completely tax-free and do not show up on your tax return at all. The contrast with traditional accounts matters enormously because Roth withdrawals do not push you into higher tax brackets, do not trigger Medicare surcharges, and do not cause your Social Security to become taxable. This is the cool ingredient, the one that adds substance without adding heat. Understanding when and how to use it is one of the most important decisions you will make. The third ingredient is your taxable brokerage account, the one that is not inside any retirement wrapper. Gains here are taxed as capital gains, which often carry a lower rate than ordinary income, and you only pay tax on the gains, not the full withdrawal. This account gives you flexibility because there are no age restrictions and no required withdrawal schedules. The interplay between these three ingredients is the foundation of every strategy we are going to discuss. Now that you know what is in the pantry, the question becomes how to cook with it. Most people approach retirement withdrawals with a simple and seemingly logical instinct. They think they should take money from whichever account has the most in it, or they withdraw from their traditional IRA first because that is where the biggest balance sits. This feels responsible because it seems like you are drawing down the account that is costing you the least to maintain. The intuition is clean and tidy, and it is almost always wrong. Here is the first consequence that nobody warns you about. If you withdraw $70,000 from your traditional IRA in a single year, and you are also receiving $28,000 in Social Security, your combined income pushes you well past the boundary between the 12% tax bracket and the 22% bracket. That means a portion of your withdrawal that could have been taxed at 12% is now being taxed at nearly double that rate. The jump from the 12% bracket to the 22% bracket is not gradual. It is a cliff, and most people walk right off it without looking down. Every extra dollar above the threshold gets taxed at the higher rate, and the compounding effect over a full year is significant. The second invisible consequence involves Medicare, specifically the income-related monthly adjustment amount known as IRMA. Medicare uses your tax return from 2 years ago to decide what you pay for Part B and Part D premiums today. And if your modified adjusted gross income crosses certain thresholds, your premiums jump dramatically. A married couple filing jointly that crosses the first IRMA threshold could pay over $410 per month per person for Part B, instead of the standard $185 base premium. That is an extra $5,400 a year in Medicare costs alone, triggered not by a raise or a windfall, but by a withdrawal you made from your own retirement account. Most retirees have no idea this surcharge exists until the letter arrives from Social Security 2 years later. This cost compounds every single year that your income stays above the line. The third consequence is the taxation of your Social Security benefits, and this one creates a cascading effect that is hard to see until you map it out. If your combined income, which includes half your Social Security plus all other taxable income, exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security becomes taxable. That means the benefit you were counting on as a tax-free baseline suddenly adds thousands of dollars to your taxable income. Picture this happening to your own Social Security check, and then run the numbers on your last year of withdrawals to see whether this cascade has already started building in your own returns. The cascade works like this. A larger withdrawal raises your combined income, which makes more of your Social Security taxable, which raises your income again, which can push you into a higher bracket or trigger IRMA. Robert, back at his kitchen counter in Charlotte, does not know any of this yet. He has been withdrawing $5,200 per month from his traditional 401k because his advisor told him years ago that a 4% withdrawal rate was safe. He has not looked at what bracket those withdrawals are landing in, and he has never heard the word IRMA. The dominoes keep falling, and each one knocks over a slightly larger one behind it. The real cost is not what you pay in any single year, but what you overpay cumulatively across 15 or 20 years of retirement. If you are paying an extra $6,400 per year in unnecessary taxes and $3,800 per year in avoidable Medicare surcharges, the math over 18 years comes to more than $183,600 that left your portfolio and went to the federal government instead of funding your life. That is not a rounding error. It is the difference between leaving an inheritance and running out of money at 87. There is a window between the year you retire and the year your required minimum distributions begin at age 73, and this window is one of the most valuable assets in your entire retirement plan. During these years, your taxable income often drops dramatically because you are no longer earning a salary, but the IRS has not yet started forcing money out of your traditional accounts. Most retirees treat these years as a vacation from financial planning, and that is exactly the mistake that costs them the most. The golden window is your chance to rearrange the ingredients in your recipe while the oven is cool. And once RMDs start, the temperature gets set for you. The counterintuitive strategy is this. During those low-income years, you deliberately convert money from your traditional IRA into your Roth IRA, paying tax on it now at a rate that is far lower than what you would pay later. The math behind this is straightforward. If you can convert $40,000 per year at the 12% bracket, instead of being forced to withdraw $78,000 per year at the 22% bracket, once RMDs kick in, you save 10 cents on every dollar. And that savings compounds across every year of remaining life expectancy. This is not a loophole or a trick. It is simply filling the lower tax brackets intentionally instead of leaving them empty. The recipe calls for adding this ingredient slowly, at a controlled temperature, not all at once when the oven is already hot. Each dollar you convert to Roth today grows tax-free for the rest of your life and never appears on your tax return again. That means it will never trigger IRMA, never make your Social Security taxable, and never push you into a higher bracket. If you convert $40,000 this year and that money doubles over 12 years inside the Roth, you now have $80,000 that is completely invisible to the IRS. The long-term effect is that your RMDs shrink because your traditional IRA balance is lower, which means your future tax bills shrink, which means your Medicare premiums stay lower. The question you need to answer is whether you have been filling your lowest tax brackets each year or letting them sit empty while your traditional IRA balance keeps growing toward a much larger forced withdrawal. This is the central insight of retirement tax planning. Paying a small tax now to avoid a large tax later is not a loss. It is the best return on investment most retirees will ever find. The people who understand this build a retirement that gets more comfortable every year instead of slowly tightening. Your retirement is a recipe that rewards patience and precision. Those who measure carefully end up with a result that sustains them for decades. Meet Eleanor. She is 64 years old, recently retired from a school district administrative role in a suburb of Denver, Colorado. She has $310,000 in a traditional 403(b), $42,000 in a Roth IRA, and $61,500 in a taxable brokerage account, for a combined total of $413,500. Her Social Security benefit at 66 will be $2,180 per month, or $26,160 per year, and her annual living expenses, including health insurance, run about $54,800. Eleanor does the simple thing and starts pulling the gap between her Social Security and her expenses entirely from her traditional 403(b), which means she withdraws $28,640 per year. Combined with her Social Security, her provisional income crosses the threshold where 72% of her Social Security becomes taxable, adding another $18,835 to her taxable income. Her effective federal tax bill for the year lands around $5,870, and her Medicare Part B premium stays at the standard level for now, but is on track to increase once her RMDs begin pushing income higher. If your withdrawals look similar to Eleanor's, you are not alone, but you should know this approach will cost you steadily more over the next 2 decades. Now meet Kenneth. He is also 64, recently retired from a logistics management position near Richmond, Virginia. He has $285,000 in a traditional 401k, $88,000 in a Roth IRA, and $47,500 in a taxable brokerage account, totaling $420,500. His Social Security at 66 will be $2,240 per month, or $26,880 per year, and his expenses are $53,600 annually. Kenneth approaches his withdrawal differently. He takes $12,400 from his taxable brokerage account, paying only long-term capital gains on the portion that represents growth, which comes to roughly $1,860 in federal tax. He then pulls $14,320 from his Roth IRA, completely tax-free, covering the rest of his expense gap without adding a single dollar to his taxable income. Because his only reportable income is Social Security and a small capital gain, only 41% of his Social Security becomes taxable, saving him nearly $2,740 in federal taxes compared to Eleanor's approach. His total federal tax bill for the year is approximately $2,310, which is $3,560 less than Eleanor's. The recipe is the same set of ingredients, but Kenneth measured the proportions and controlled the temperature. Kenneth also converts $31,200 from his traditional 401k into his Roth IRA that same year, carefully filling the 12% bracket without crossing into the 22% bracket. The tax on that conversion is approximately $3,744, which he pays from his brokerage account. And in exchange, that $31,200 will now grow tax-free and never be subject to RMDs. The math over the next 8 years of conversions before his RMDs begin at 73 means he will move roughly $260,000 out of his traditional account, shrinking his future forced withdrawals by more than half. If your income is low this year because you recently retired or cut back your hours, this is your window, and it will not stay open once your traditional balance forces the IRS to set your withdrawal schedule for you. Over a 20-year retirement horizon, the cumulative difference between Eleanor's approach and Kenneth's approach exceeds $94,000 in total tax savings, and that does not include the additional compounding of Kenneth's larger Roth balance or his lower Medicare premiums in years 15 through 20. Nearly $100,000, separated not by how much they saved, but by the order and timing in which they spent it. That is the power of getting the recipe right. The first thing to do is gather every account statement you have and write down the current balance, the account type, and whether it is pre-tax, Roth, or taxable. You need to see the full pantry before you can plan the meal, and most people have never put all 3 account types on a single page. This takes about 30 minutes, and it changes how you see your retirement immediately. The second step is to map out your income sources for the coming year, starting with Social Security if you are already collecting it. Write down your expected annual benefit, any pension income, any rental income, and any part-time earnings. Then calculate the gap between that income and your total annual expenses, because that gap is the amount you need to withdraw from your portfolio. Knowing the exact size of that gap is what lets you make intelligent decisions about where to pull from. The third step is to fill that gap strategically instead of pulling from one account. Start with your taxable brokerage account for the portion that carries the lowest tax cost. Then use Roth withdrawals for the rest if you need to stay below a bracket threshold or an IRMA line. Once your basic expenses are covered, look at how much room remains in the 12% bracket and consider converting traditional IRA dollars into your Roth up to that boundary. This is the step where you turn a passive withdrawal plan into an active tax strategy, and it is the single move that generates the most long-term savings. The fourth step is to do this review every year before December 31st, because tax brackets reset with the calendar, and any unused space in a lower bracket is gone forever. Your next move matters more than any move you have already made, and before this year ends, you owe it to yourself to sit down with a CPA or a fee-only financial planner who can run the projections with your specific numbers. A single planning session that costs $300 can save you $4,000 or more in that same tax year. Do not let the perfect plan become the enemy of a good first step. Robert is still sitting at that counter in Charlotte, but the page in front of him looks different now. The number $738,400 has not changed, but he is beginning to see that the number was never the real question. The real question was always about sequence, timing, and temperature, about which dollars to move and when, about filling brackets before they fill themselves. He does not need more money, he needs a better recipe. And the ingredients have been in his pantry the entire time. Every recipe has a moment where you either trust the process and let the dish come together, or you panic and throw everything in at once. Your retirement is the same way, and the people who measure carefully, who respect the timing, who adjust the seasoning year by year, are the ones who sit down 20 years from now to a meal that is still warm. The comfort of your retirement is not decided by the balance on a single page, but by the thousands of small decisions that follow it. Drop a comment below telling me the one thing about your own withdrawal plan that you are going to look at differently after today. If this changed how you think about your accounts, a like helps more people find this conversation who need it right now.